Our next guest warns too much is going wrong for sustainable market bounce. Peter Boockvar is the chief investment officer at Bleakley Advisory Group and a CNBC contributor. Peter, we were debating here on the desk. We had bad news come out in the markets, or what could have been perceived as bad news just a couple weeks ago, and the markets rally. Isn't that a good thing?
Yeah, for now it is. I think this is in the context of early last week, where sentiment was extremely dour. You've had in the AAII survey, bears above 50, bulls in the teens. The CNN Fear Greed Index got into the mid-single digits. Investors' intelligence showed well more bears than bulls. And I think that there's hope that maybe inflation numbers have topped out, which they likely have. But then a separate debate is how far does it fall? That we priced in the rate hikes. And I think people somehow believe that there's this soft landing. What amazes me, though, is that earnings estimates for this year have not changed one bit, which implies the market's belief that we will have a soft landing and somehow the Fed is going to pull this off. And we're also in this information vacuum. We're sort of at the end of earnings season, and we don't have a Fed meeting until, for the next couple of weeks, but we already know what they're going to do. And the real next big catalyst is not until earnings season in middle of July when we review Q2 results, and I think when we get deeper into QT, which we know started this week.
Peter, it's Tim. I know we all question whether the Fed could even have any data, and certainly their track record's awful. I referenced your note yesterday where you talked about Bill Dudley is kind of the truth speaker, the truth serum man of the Fed. Give us your sense, even in a world where the Fed can't predict out 3 months, we know they have nothing special in terms of information. Is the Fed underestimating what they have to do?
I think that the Fed has their fingers crossed, hoping that if they can temper the demand side enough, over time the supply side will somehow fix itself, and they'll get a sharp drop in the inflation rate. The U.S. economy is way more complicated than an econometric model can predict, and that is when they're easing, and that is certainly when they're tightening. So they're going to tighten because they know they need to play catch up here. They were mugged by the reality of inflation running at 8. They have the Fed funds rate today at 1. Yes, we're pricing in maybe 3. So I think they don't even know how the economy is going to respond. Jay Powell said that himself at the last press conference when he was asked, what's the impact of QT going to be? And he basically said, I have no idea.
That's fair. But doesn't that argue for the Fed being a little bit cautious, because we don't know what the impact of QT can be, and that could be another wallop in terms of tightening that we just can't quantify right now. So why not just sort of take it easy and not, we were saying earlier today, pull the Band-Aid off. Maybe it's not that easy.
It is not, and I agree. And I think we got a hint of that from Brainerd when Sarah asked her, what are you going to do in September? Because we know you want to raise 50 in June and July. And she even said, well, if the inflation numbers are high, we'll go 50. And if they're not, maybe we do 25. So they have left it open at that September meeting to be more actually data dependent, where we know they have been less of that over the past couple of years. So I do think that they are sensitive. And it's not just the Fed. The European Central Bank has acknowledged their sensitivity to their pace of tightening and its impact on the actual economy. And they got an even deeper problem with inflation above 8%, and they still have rates below 0. So I agree that there is that sensitivity, but that is the difficulty of what they're trying to accomplish here.
Peter, thanks for your thoughts. Appreciate it. Peter Boockvar, Bleakley Advisory. Dan?
I love Peter's work. You guys know I'm a big dummy. I read guys like him every day, but I really think this inflation. I know what you think. I just think this inflation thing is transitory. I mean, I really do. I think that we're going to be looking back in a year from now.
But it's transitory.
I don't know. I mean, whatever. My point is like I think the markets. I think the stuff is we're going to suss it.
Then buy equities.
But again,
wouldn't you buy equities?
But that's maybe why a lot of people are saying the bottom is in. Maybe that was it. I'm just saying, like, when you think about the disconnects and all the stuff that we've seen and all this, the post-pandemic stuff and the war in Europe and what just happened. I mean, China was just locked down, 25 million citizens in Shanghai for 2 months. I just feel like that.
Wouldn't that be inflationary though? If they're coming back on?
I think there's so many things that are inflationary. I just think we're going to kind of come back to trend, and I don't think we're going to be dealing with high single digits inflation for that long. I just don't.